Hi everyone, my name is Alex Guo. Today, I will be giving an introduction on understanding the current cryptocurrency landscape. So without further ado, let's get started. So today, I will break it down into 7 parts. So my first part, I'll be giving an introduction, a quick background on crypto, what's really going on here. Part 2, I'll be giving a primer on crypto, so some of the crypto basics, some of its concepts. Part 3 and 4, I'll be diving a little deeper into specific cryptocurrencies and blockchains, specifically Ethereum and Bitcoin. In part 5, I'll be comparing the two, and then in 6 and 7, I'll be talking about the risks of crypto as well as the potential future outlook. For an introduction, many people perceive the cons of the current traditional finance system being high transaction fees, longer waiting periods, an opaque, non-transparent system, as well as barriers for emerging markets. So what's a possible solution? Well, many people believe that to be cryptocurrency. People believe that there are many pros to decentralization, a concept that I'll touch on later ahead. For example, quicker, more seamless transactions on the blockchain, minimal transaction costs, greater accessibility, and newfound opportunities for many unbanked regions, as well as greater transparency, as these transactions are publicly recorded, though it is important to note that privacy is still restored. So many people believe that cryptocurrency really stems inherently from the radicalization of the monetary system. It's really stemmed in that belief that monetary evolution is based on technological advancements and its subsequent efficiency improvements. As we've seen, anywhere from bartering to physical objects to paper money, now we're in the era of electronic money. But many people see the future of efficiency with the rise of AI and other technological advancements as cryptocurrency being the next rational step. So before we dive in, let's address some common questions and misconceptions that are often thrown around in the cryptocurrency landscape. The first question being, we currently use digital currency, but how does that really differ from cryptocurrency? Well, just because money is digital doesn't mean that it's necessarily decentralized. Money now is still controlled by a central authority like a bank. The real difference here lies in architecture and philosophy, which we'll dive deeper on later ahead. Number 2 and 3 are concepts that we'll also talk about later ahead. Ethereum and Ether are not the same thing. Lastly, Bitcoin and Ethereum are not direct competitors. They actually serve fundamentally different purposes in the crypto world. So now I'm going to give an introduction and a quick primer on crypto. So what actually is cryptocurrency? Well, it's a digital currency where transactions are validated and stored by a decentralized system rather than a centralized authority. Let's dive deeper into what decentralized and centralized actually means. Well, in a centralized system, transactions are validated through one governing body, for example, a bank or a financial institution. On the other hand, a decentralized system operates without a central authority, and this is through what's called a blockchain. So, in a decentralized system, it's where users of the blockchain actually validate these transactions and legitimize the blockchain through its usage. But what actually is a blockchain? In its most simple sense, is a form of a digital ledger that tracks, validates, and protects transactions. Now let's really break down what blockchain actually means. So a block in this sense represents individual transactions that are all bundled up together, whereas a chain represents how the blocks are linked in order, forming a secure timeline of records. Why is it decentralized? Well, it's based and it's rooted in that idea that no central authority, like a government or a bank, actually runs the blockchain. Instead, users validate these transactions. Transactions in this sense can refer to any form of crypto transfer, sending Ethereum, USDC, etc. So now I'm going to dive into, how exactly is this system validated? And it's really done through 2 main steps: smart contracts and a native proofing system that's specific to individual blockchains. So a smart contract, think of it as a digital agreement. It's the rules for a transaction, but now it's written in code. It runs automatically when both sides, a buyer and seller, meet the terms. Why is this important? Well, now it's code that enforces the deal instead of like a lawyer or a middleman. This makes transactions faster and much more flexible on a blockchain. Now let's talk about the proofing system. So in proofing, this is actually how to protect the blockchain. We talked about in smart contracts, this is the introduction of a transaction. This is the part of the blockchain that actually checks and confirms transactions, and it's based on a form of a consensus mechanism. What's the result of this? Well, after proofing, the transactions are immutable, meaning that they can't be changed or in any way affected. Different blockchains operate using different methods of proofing. And we're gonna explain more of the details later, but Bitcoin uses proof of work and Ethereum uses what's called proof of stake. So just to summarize the order of operations when it comes to smart contracts and proofing, it starts when a smart contract initially gets called, but it's not yet approved. That's the main point, when transactions actually occur. And then this is when the proofing occurs. This is how the transaction actually gets verified, and it gets placed into a block to get added to the blockchain. Finally, after the proofing, the smart contract actually gets executed, leaving both the buyer and the seller satisfied. So just to summarize, a cryptocurrency is a form of a digital currency on a decentralized system. Decentralization ultimately means that no central authority runs the flow of cryptocurrency. And the blockchain, in the sense, means that it's a digital ledger that validates transactions. And a blockchain really acts as the infrastructure of a decentralized network. What are these validations? Well, it's through smart contracts and proofing. And then what are these transactions on the blockchain? It's any flow of all kinds of crypto assets. So now I gave a primer on crypto, but I wanted to get a little deeper into specific forms of cryptocurrencies. The two main ones we hear about are Bitcoin and Ethereum. So now let's talk about Ethereum. I'm gonna break this down into three main points. I'm gonna give an overview on how it works, the applications of the Ethereum blockchain, as well as the value drivers, what actually correlates to the market value of Ether. So what is Ethereum? Well, it's a blockchain whose main value proposition is derived from its programmability. It's really important to note that Ether and Ethereum are not the same thing. Ethereum in itself is the blockchain. That is what we were talking about earlier. It's the infrastructure. ETH, Ether, is what enables the Ethereum system to operate. Think of it as a form of like a digital fuel. In a more specific sense, this is called the native currency, and it's actually the transaction cost of actually wanting to use the blockchain. I think this analogy might make things more simple. Think of Ethereum blockchain as a highway system. That's the actual infrastructure required for a car, which we want to think about as an actual transaction on a blockchain, that wants to go from location A to location B. Whereas on a blockchain, transaction wants to go from user A to user B. But the only way for the car to actually run is through gas. These are the ETH fees that are actually needed to drive the blockchain system. In essence, you pay a fee in ETH to keep the system running. So the Ethereum is the blockchain, while ETH is what requires the blockchain to actually operate. So I talked a lot about these fees. I introduced this new concept, but where do these ETH fees actually end up? Well, the majority of the fee actually goes to what's called the burn mechanism, which is really essential to how the blockchain operates on Ethereum. Most of this transaction fee gets burned, which actually shrinks the total ETH supply. This is a main value driver of ETH as it creates a scarcity value. So the remaining of the fee actually goes to Ethereum's proof of stake. Like we talked about before in the introduction to crypto on the different proofing systems, this is Ethereum's native way of proofing and validating the system. So remember, proofing again is how the decentralized blockchain validates transactions. Specific to proof of stake, this is when individual Ether holders can actually stake, meaning that they lock up their coins into the blockchain. Then the stakers must actually validate the transactions through a consensus mechanism, using their own computational power to do so. So you might be wondering, why would anyone choose to lock up their coins on the blockchain? Well, it's because there are incentive mechanisms in place to actually do this. For a correct selection, if stakers accurately validate the system, they're able to earn yield on their staked coins. Whereas in an incorrect selection, it leads to slashing, which is a concept where the stakers lose either part or all of their stake coins. I wanted to give, kind of an overview on the dynamics between staking and yield. As you can see in this image, right now, there are around 35.5 million Ether being staked, while the cumulative APY rate is around 2.86%. As you can see from this graph, with the green line showing the total Ether staked and the purple line showing the actual cumulative yield, as demand for staking goes up, the actual yield, the APY, goes down. Supply and demand dynamics essential to the blockchain. This leads me to my next point on burn versus yield, and I'm going to talk about it in the sense of an inflation versus deflation mechanisms. Yield is inflationary, as we know from staking your coins, as new Ether is being generated. However, from the deflationary aspect, occurs when the transaction fees are actually burned through what we talked about earlier, the burning mechanism. As demand for this blockchain will rise, this will thus decrease supply through the burn mechanism and increase ETH prices as a result. It's important to note that in the worst case scenario for the blockchain, think, max staking but minimum blockchain usage. The ETH algorithm actually caps the max annual inflation rate at 1.5%, which is a safeguard mechanism against hyperinflation. This other diagram is very important. It shows the supply of Ether on a 1-year trailing basis. What we're seeing right now is an inflection point from an inflationary to deflationary on the Ethereum blockchain, as increased usage of the blockchain leads to more burning. Let's really tie it all together. I talked about a lot of concepts, but let's all bring it back to make it make sense. This is the full Ethereum transaction process. In this example, user A wants to send 1 Ether to user B through the Ethereum blockchain. When this starts, a smart contract gets called, but not yet approved. Not only does user A send 1 Ether, lose 1 Ether, but remember, there's also gas fees that are incorporated. Where does most of these gas fees go? Well, like we talked about, most of it actually gets burned, the burning mechanism. The rest of it goes to the proof of staker. Not only does the proof of staker gain that gas fee, but it also gains part of yield, newly issued Ether. This proof of staker is the one that is responsible for using computational power to execute and validate transactions on the network. Then, these transactions are then verified by a greater Ethereum network, the consensus mechanism. After this is all done, user B receives the 1 Ether as the smart contract gets approved. So why actually does this work? It all comes down to incentives. And on the blockchain, incentives are aligned. Think about it in a traditional centralized finance system. Why do people lend money to the bank? Well, it's because they receive interest. On a decentralized blockchain, it's not that much different. Users that choose to proof the system, remember, protect and validate it, actually receive compensation for their efforts through the system's native currency, which in this case, on the Ethereum blockchain, is Ether. So now that you understand the dynamics going on the Ethereum blockchain, what are some of the applications? We talked about why Ethereum is very programmable, and that really comes down to its applications. Ethereum is very programmable because it's able to actually support a lot of dApps that are critical for the actual usage of the blockchain. Now let's talk about some of the applications of Ethereum. We just gave a quick overview, and now these are some of the important things that you can actually do on the blockchain. So the big ones are actually called decentralized apps. And decentralized applications are pretty much just any form of application that actually runs on the blockchain of Ethereum. This is through smart contracts, not centralized servers. And some examples of this include DeFi, stablecoins, and tokenization. Let's start talking about DeFi. DeFi is the financial infrastructure. It's essentially finance on blockchains. Within DeFi, there's stablecoins and tokenization. Now let's talk a little more about what stablecoins are. Stablecoins are essentially cryptocurrencies, but are pegged to a fiat currency and are used as a crypto medium of exchange. They're pegged to reserves and over-collateralized for security. Some of the main examples that we see online are USDC for the Circle coin and USDT for the Tether coin. Stablecoins give you accessibility to many of the benefits of a blockchain. For example, the 24/7 instant transfers without the need for banking delays. There's also many low fees on the transaction process, also giving greater accessibility for unbanked regions. Additionally, this is another important thing to note, but like I mentioned earlier, as stablecoins being a crypto medium of exchange, it provides a safe haven during times of crypto volatility, which is essential for what we know of crypto being a very volatile asset. This is because it can act as like a medium for between Bitcoin, for example, cryptocurrencies, as well as the fiat currencies. The last one that I want to talk about is tokenization. Tokenization is essentially a digital representation of real-world assets, for example, stocks, real estate, or luxury, except now all bundled into a blockchain. These tokens are backed one-to-one by the underlying asset. Again, tokenization provides many of the benefits to a blockchain, enabling 24/7 trading, ownership, and settlement. Why is Ethereum the main blockchain for these applications, you might wonder? Ethereum in itself is the legacy product for blockchains. It already has a strong network effect, giving it a strong economic moat. It's also the most decentralized blockchain, as well as the most test secured and reliable. Furthermore, like we mentioned earlier, Ethereum is very programmable. That's the purpose it was built for. It's very easy to build on with these dApps. Now we've established the role of Ethereum in the crypto landscape, but how does this actually contribute to the market value of ETH? That's what we're gonna be talking about next. The value drivers. As of July 31st, 2025, around 12 p.m. EST, ETH was selling around $3,800 per coin with a market cap of over $450 billion, giving it a volume of over 35 billion, so extremely large numbers. But what really makes up these numbers, what's the value composition? What actually drives Ether's value? Well, I see it in 5 main ways. The first one, like we talked about earlier, being staking yield, which is increasing the incentives to actually buy ETH. Additionally, the gas utility and the burn scarcity associated with ETH. As demand for the blockchain increases, that also increases ETH gas fees, which leads to more ETH burning, like we talked about in the burning mechanism, which ultimately leads to supply shrinkages. So a lot of supply and demand dynamics going on there. Thirdly, DeFi and other forms of applications that can be built on top of the Ethereum blockchain. Like we established, Ethereum is the main blockchain used, which requires ETH demand to run. 4 and 5 are also important to note. So the monetary policy premium, which stems from the idea that Ethereum in itself, being a decentralized system, makes it a predictable issuance mechanism that also attracts demand. Lastly, speculation is a very big part, as there are many bulls right now in the crypto market industry. Additionally, some of the economic aspects of the Ether coin, Ether is a productive asset, meaning that it can gain yield from staking. It's also deflationary. So even though there are technically no limit on the total number of Ether, however, the internal burning mechanism from transactions on the Ethereum blockchain reduces the total ETH amount. Lastly, even though, like we described, this is not the main purpose, but it can also be used as a tradable currency. We talked a lot about Ethereum, and we talked about an overview, different applications, value drivers. So now let's shift gears a little bit and talk about, the household name, Bitcoin. I'm going to start off by giving a quick overview. Bitcoin is a cryptocurrency that's designed to act as a form of payment and store of value. It uses its own Bitcoin blockchain, where BTC is the native currency. Bitcoin is non-programmable, unlike Ethereum, which is made to actually be accessible for these other dApps. We talked about the proofing system, how the blockchain actually validates transactions, and Bitcoin uses what's called miners. They receive BTC reward for validating and protecting the blockchain transactions. This reward comes in 2 mechanisms. One being new issuance from creating new Bitcoin, as well as coming from the transaction fees that are actually required through the blockchain to use it. What do miners do in return for the reward? They solve complex code puzzles that require high amounts of computational energy. And these code puzzles ultimately help it to verify the transaction chain. Again, to note, this requires much more energy than proof of stake. It's also important to note that this more energy aspect also adds to its value driver mechanism. Additionally, there's also an inflationary mechanism going on. So how does Bitcoin actually control its supply and inflation? Well, it's inflationary. So that comes from the mining. And unlike Ethereum, there's actually no burn mechanism that's relative to Bitcoin. However, this inflation is actually controlled through 3 main processes. The first one being halving. The halving process is basically Bitcoin's internal form of monetary supply control, which limits the amount of newly issued Bitcoin. Additionally, there's a capped supply of total Bitcoin that's going to be possible to actually be issued. And this is at 21 million. Eventually, Bitcoin is projected to be non-inflationary, with people believing it to be around the year 2140. Lastly, there are many difficulty adjustments that are associated to the actual mining process. The goal for on the Bitcoin blockchain is that mining occurs around 10 minutes. And based on the changes in computational energy and technological advancements, etc., Bitcoin actually controls how difficult the puzzles are relative to that. Again, we went through a lot. Now let's tie this all back together again. So like we did for Ethereum, let's go through the Bitcoin transaction process. So let's start at user A, where user A wants to send now 1 BTC to user B. Again, user A not only loses 1 BTC, but also has to pay an additional gas fee in its native currency, which, since we're on the blockchain of Bitcoin, BTC. This smart contract gets called, but not yet approved. And then the gas fees go to the proof of worker, the person or the validator. And the proof of worker collects both the gas fee as well as newly issued BTC through mining. What does the proof of worker do in return? Well, again, it uses computational energy to execute transactions on the network. These transactions are then further verified by the whole entire decentralized Bitcoin network through its consensus algorithm. Finally, after all of these validations occur, user B receives the 1 BTC and the smart contract gets approved. After giving you a quick overview, let's talk about some of the actual applications and value drivers of Bitcoin, which are very notably different than Ethereum. So as of yesterday, July 31st, 2025, around 12 p.m. EST, Bitcoin was trading at nearly $120,000 per coin, with a market cap of 2.35 trillion and trading volumes of nearly $7 billion. The thing about Bitcoin is that it's non-programmable, so there's no native support for dApps like Ethereum. Instead, its purpose is built for a decentralized, censorship-resistant store of value, as well as a peer-to-peer payment system like a digital cash. After going through all of those, now let's actually compare the differences between Ethereum versus Bitcoin, because this is very essential and they're really not the same at all in the cryptocurrency landscape. Bitcoin and Ethereum are not competitors. Bitcoin functions as a store of value, whereas Ethereum functions as a blockchain. And Bitcoin, again, is focused on value transfer with a native currency of BTC and minimal programmability, while Ethereum is really focused on its blockchain utility. And its native currency is ETH, and on the other hand, it's very programmable. Finally, Bitcoin has a capped supply of 21 million coins, while Ethereum is uncapped. The bottom line is that they serve fundamentally different purposes in this landscape, but also that Ethereum can complement Bitcoin, not only as a store of value, but also facilitation through transfer, trust, and global coordination. I like to think of it like this. Think of gold as Bitcoin and silver as Ethereum. Gold, like we know, is valued for scarcity and store of value. And it's really used to preserve wealth, not necessarily for everyday use. However, on the other hand, silver serves as both monetary and for its industrial purposes. Because not only does it serve for a store of value, but it's also critical in electronics, solar panels, and semis. As we can see with Ethereum, its utility comes from its purposes for blockchain programmability, very similar to how silver has these capabilities. So what are some of the risks of crypto that are potentially poised for the present and for the future? Well, the biggest thing is really security and technology. While blockchains are ran through what's called the SHA-256 protocol, which is the most secure protocol on the market right now. However, key theft and smart contracts through its exploitation still remains at risk. Additionally, the rise of quantum computing, which a lot of people talk about on the news right now, really poses a concern potentially for SHA-256 protocol, as many people worry that as quantum computing rises, and it could potentially complicate, the security of the SHA-256. Lastly, with increased usage of the blockchain, networks can get congested and slow. For example, even though Ethereum has L2, which is basically its native scaling capabilities, as the blockchain really increases, networks in itself can also slow down the transactions, which ultimately fundamentally questions some of the benefits that people receive from a blockchain. Additionally, there are many market concerns. Crypto in itself is a very volatile asset. Additionally, many people are believing it to be some form of speculative bubble. For example, many notable names such as Warren Buffett and Eugene Fama have often criticized cryptocurrency for its really lack of intrinsic monetary value. Lastly, stablecoin depegging is always a concern. For example, we've seen this historically through the Luna and Terra coin on the markets, which has caused a lot of monetary ramifications. Lastly, regulatory barriers. So right now, there are certain bans and restrictions that are currently in place, China, for example, with heavy crypto regulations. Additionally, there is an uncertainty about the legal status of cryptocurrency. Recent Genius and Clarity Acts through Congress have shown promising acceptance from the US government, as well as the SEC and CFTC. So what does the future outlook look like? We talked about the risks, but what about some of the potential future things that are poised for cryptocurrency? It's important to note, before I get into that, some of the additional cryptocurrencies that are also gaining some traction. For example, Solana, XRP, Ripple, and Polkadot. These are other forms of blockchains with specific utility, and they also attempt to solve real problems within decentralized finance. Meme coins are also something to consider. These are created through cultural memes and internet volume, for example, Dogecoin, but they often have minimal to no really true innovation. And most of the value really comes from speculative trading through community engagement. Think of it as a lack of utility, ultimately created through internet hype, often lacking an intrinsic value proposition. So now, what's the potential future outlook for crypto? Firstly, stablecoin adoption is something that has been really popular right now on media. And what's really the incentive behind that? Well, we know that stablecoins are backed mostly by T-bills and the US underlying USD. And that creates a lot of incentive for softening the US debt burden. Right now with the big beautiful bill that recently got passed, we see, an additional $3.3 trillion added to the government deficit. And that's really a big concern that many people are worried about. And the belief is that stablecoins would bring back desire for T-bills as well as other forms of US treasuries that could help soften this. We've seen the dollar lose its value in recent times. And the belief is that through, again, stablecoin adoption, many of which are most popularly backed by USD, this could help to bring back strength of the dollar through global recognition. We see this through Congress through the Genius Act, as this was recently passed and provides a regulatory framework for stablecoins. Additionally, ETH staking and ETFs. For example, BlackRock recently filed an SEC application to add staking to their Ether ETFs, which would ultimately give investors exposures to such staking yields. Tokenization is also something that potentially could be poised for the future. We see Goldman Sachs recently issuing tokenized money market funds, as well as Apollo. Additionally, big platforms such as Robinhood creating some efforts in trying to tokenize private markets. I believe that the Trump organization also could potentially be bullish for the future of crypto, as they've made it quite clear for their desire of the US as a crypto and AI superpower. Additionally, with the passing of the Clarity Act, this really sets regulations and terms for digital asset classes. For example, what's going to be classified as a security, what's going to be classified as a commodity. And this is really important for setting regulatory measures. 2 days ago on Wednesday, we saw the report of the White House crypto. And this really urged a sentiment of, pro-innovation mindset, as well as addressed potential illicit finance on the blockchain. So again, ultimately, we're seeing a lot of more regulatory frameworks for crypto. All in all, there's definitely a lot of future for the potential risks and possibilities for the future of crypto as we see it. So thank you all for tuning in. We really hope this presentation helped clarify the complex and fascinating world of cryptocurrency. Big thank you to Megan Hawes for editing this presentation, and to Charles Zhang, founder and president of Zhang Financial, for the opportunity to speak on this platform. We appreciate your time and interest, and we look forward to sharing more insightful content with you in the future. Please stay connected, and see you next time.